Welcome to yCITIES Inside the Mind of an Investor series. Angel investors are a vital part of the startup community, often a source of funding for innovative problem solvers. While there are plenty of resources about how to pitch or how the process works, it can still seem like a black box as to why an investor chooses to invest or not only to the founders, but also to peer investors. So we decided that we wanted to have many conversations with many different investors and to focus on one investor at a time. Since yCITIES cultivates an innovation ecosystem of intergenerational, open-minded thinkers, we wanted a panel of hosts that reflects a range of life stages. And normally we also have Shawn Harris, who's an active angel investor, a member at TBD Angels. He's under the weather today, so he will not be joining us. But I'm very excited to introduce our guest investor today. Welcome, Warren Katz.
Hey, Vicky, how are you?
Good. So just to kind of start the conversation off, can you tell us a little bit about yourself and kind of a soundbite of your journey leading you up to becoming an angel investor?
Sure. So I'm an engineer by training. I have degrees in mechanical and electrical engineering. I started my career working at a large defense contractor in Cambridge. Came to realize pretty quickly I did not want to work in an hourly business model as most defense contractors do. So I started my own software company in 1990, a company called Mock Technologies. Myself and a friend of mine from our old defense contractor company left. And we intended to develop commercial off-the-shelf products, which is a much more fast-growing, lucrative business than defense contracting. Our technology area was simulation software, military simulation software. And so we sold our products back to essentially the large aerospace industry. Built that company all off of government grants, never raised any venture capital or angel investment of any kind. So it was a bootstrap company, which is kind of an unusual story. Sold that company in 2006 to one of my customers, a large aerospace company called Singapore Technologies, and stayed on for a few more years, and then left in 2012 and just became an angel investor and mentor in the Boston startup scene. With a specialty or expertise in how to fund one's company with government grants instead of, or in addition to, venture capital and angel investment. Did that for about 5 years, then had a small stint as the president of one of my investments, a company I invested in called Neurala. They had raised a large A round, needed somebody with experience in how to structure and grow a software company. So I went on there for a few months. Then that's when the US Air Force called TechStars and asked TechStars to stand up an Air Force accelerator. TechStars knew that I had experience in how to do government contracting, so they asked me to help close the deal with the Air Force. I did, and they also asked me to run it. So from 2018 to 2020, I was the managing director of the Air Force Accelerator powered by TechStars here in Boston at 3 cohorts, 10 companies per cohort. That ended in May of 2020, and then I'm back to just mild angel investing, helping companies in my portfolio, sitting on a few boards, nothing too strenuous.
Excellent. And what's your current investment thesis when you're talking about these angel investments?
Yeah, so I'm not aggressively seeking out new investments at this point. I've invested a total of, including my TechStars portfolio, about 80 companies, of which 25 or so have either exited or folded, one of the two. So I still have something in the order of 50 companies I have to keep track of, which is more than enough for any one angel investor. Some of them have outgrown me, which is awesome. If they're still in business and they've outgrown me, that means they're doing very well. If they're still in the business and need my help, that's okay, but that means that they're not beyond me yet. But I do still take meetings. I do still listen to pitches here and there, and I do still angel invest at a pretty slow rate. So what is my thesis? I usually invest in deep tech, hard tech, whatever you like to call it, something with a defensible technological moat. I usually also only invest in things that I think I can assist the company in getting some government funding to amortize or subsidize their R&D and their product development. For me, this appears to be I did it, on the extreme, I did it 100% funded my company with government contracts, but a combination of government contracts and venture capital or angel investment is a nice mix, which reduces the risk that an investor takes. It reduces the amount of equity the company has to give up. And the government's actually a very, very good early customer. So I have been, and I can be very helpful to the company in how to win those kind of grants. So I typically only invest in companies that have a unique technology and could win these government grants to help subsidize their product development and could potentially even sell quite a large volume into the government. So in general, that's my thesis. I stay away technologically from biotech usually because that's not my area of expertise. So it's usually things like aerospace, autonomy, AI, materials, energy sort of things, anything I think I can get the Department of Defense interested in.
So you've been investing for a super long time. Did you always have that same kind of approach to it, or was that something, because I know it's a combination of your own knowledge, so that your smart money, and then also your positive experience with getting funding from the government. Did you always invest in companies that way, or is that you kind of decided that was the formula after some early investments that didn't take that route and didn't pan out the way that you had hoped?
Yeah, so it evolved early on. My first few angel investments were things that had nothing to do with the Department of Defense. Some of them worked out. My very first angel investment was in 1996, and actually turns out to be my best. There was a video game company called Harmonix that made Guitar Hero and Rock Band. I wish I could repeat that a couple more times, but and obviously they had nothing to do with the Department of Defense. But it did have a deep technological moat attribute to it, but not the government applicability attribute to it. Over time, and I do have a number of investments that have nothing to do with the Department of Defense, but over the course of time, it became obvious that the best place for me to add value was a company that could potentially get funding from the government. So it's taken a long time to get there, but that's where I am today.
And so of the companies that have exited in your portfolio, have most of them, the ones that are successful, have most of them gone public, or have they gotten acquired? How does that usually happen?
The two best exits I've had were both acquired. Actually, I've had probably out of the 25 companies that have exited or gone under, I've had 5 or so good exits and 20 companies that have gone under. These are all very early stage companies, and even at that 20% success rate, I returned all my funding of all of my angel investments since the beginning of time. So I'm not unhappy about that. And my best investments are actually now still going, still operational. The weak ones are the ones that died early. So ask your question again. I lost my train of thought.
Basically, the successful ones, were they acquisitions or IPOs?
Okay, that's right. Yeah, all of them were acquisitions, no IPOs out of any of them. An acquisition is preferable right now because the acquirer can write a check and pay you cash if the acquirer is big enough usually, and you can just take your cash and go home. If you have to suffer through a merger, a SPAC, with a public traded entity, or an IPO, your shares as an investor are locked up for some period of time, and everybody else is able to sell while you have to sit there and watch the stock fluctuate violently up and down. And certainly at that 6-month mark, the second that the clock hits 6 months and you're able to sell, the stock falls off a cliff, and you wind up not being able to liquidate at a good price. There are ways to exit on secondary market, to sell to other people or things like that before the 6-month lockup, but that's kind of rare and difficult. So the better path is to have an acquisition. I have seen cases where companies, not in my portfolio, but companies have gone public and then get acquired right afterwards for even higher multiples. So if you sat with the stock, you could do very well with the second hit. But that hasn't happened to me. So I think most angel investors at this level would be delighted if their company got acquired, by a larger company that could just write a check.
You were talking a little bit about different ways that you sort of value a company before selecting it to be invested in. Do you mind going over a little bit of those government grants and sort of explaining to those who might not know what an SBIR is or what a SBIR is, and the difference between a phase 1, phase 2, and direct to phase 2 might be?
Sure. So the most dominant form of federal funding from the Department of Defense is something called the Small Business Innovation Research Program, SBIR. And that program has about a $3 billion a year budget. That's $3 billion each and every year that the Department of Defense has to give out every year, and they don't take any equity for it. So the bottom line is free money for a small technology business to help prototype their product. The phase 1s are range in the value from 50,000 to I think 250,000 now. Some like NSF, I think some of the others, NIH. I think some of them go over 150. So the Air Force AFWERX is the lowest one now at $50,000, but that's only a 60-day period of performance. And really the only thing you have to do for that $50,000 is to go find an end user customer inside the Air Force. It's really a market research job now instead of an actual technical prototyping job. So $50,000 is plenty of money for you to go to discover who in the Air Force would be the user of your product. The other phase 1s from the other services, Army, Navy, DARPA, NSF, whatever, that's usually some kind of either light prototyping contract to show a demonstration or a prototype, or a very complete plan for your phase 2, showing how you de-risked the entire full research program. Then the phase 2, if you're lucky and you're awarded, can range in value from usually either $750K up to, I've heard them go into the high ones, 1.7, something close to $2 million. This is just of SBIR funding, but you are allowed to add other funding to your contract. So the SBIR
Does that mean like
money,
angel funding?
no, well, so the Air Force is doing some very creative things with matching angel and venture funding in their SBIR program now. There are two later variants. One is called TACFI, TACFI, and the other one's STRATFI, STRATFI. And these are matching programs, essentially say if you can go find private investments outside from venture capitalists or even end user customers outside the military, and end user customers inside the military, there's an equation. We, the SBIR program, will award you the contract, manage the contract, and match the funding, which is kind of nice. So now a TACFI, I believe, can go up to $3.4 million, with 1.7 million coming from the SBIR budget and 1.7 million coming from external funding. And the STRATFI can go up to $60 million. It's a little more complicated. The STRATFI structure is a three-way deal where up to $15 million can come from the SBIR budget. Up to a matching $15 million must come from an end user customer inside the Department of Defense. And that sum total of up to $30 million must be matched by an outside investor of some kind, like a venture capitalist or a very large number of angels or some sort of external funding.
If there's a high level explanation of the nature of the relationship here, in addition to obviously getting money is a good thing and you get further, more milestones reached, is it also a de-risking piece of it to your kind of, so with risk tolerance as an angel investor, does this, is it one of the factors in your mental de-risking matrix? I believe these government programs are also de-risking on their end too. Is it like a symbiotic relationship there? Is there like a simple kind of answer to that question?
Absolutely. If a company comes to me and tells me I've won 2 or 3 phase 2 SBIRs already, and I have customers inside the Department of Defense testing my prototypes and they're chomping at the bit, and we're putting together large phase 3 purchases and they're loving it and whatever, that's a huge amount of de-risking and the due diligence that somebody else, an actual customer has done for me. So that, and it's also early customer traction it represents. So it's a huge, de-risking factor. A company that's never won a phase 1's never heard about it before. I'm usually a little skeptical because they should have heard about it. It's the predominant way the government funds small business. So it's something that every small business should be aware of. But if they go ahead and win a phase 1 pretty quickly, and there seems to be some traction, that's an indicator. So yeah, of course it's a spectrum. If a company comes to me and says, I've never heard of this SBIR thing. All right, let's try together to get to a phase 1. Let's talk to some customers. But a company that's has multiple phase 2s doesn't really even need the investment money because they've got a good stream of government money coming from SBIR program. That's a strong company already that's in business, prototyping, customers, and all that, and hasn't given up much equity and is not on the venture capital treadmill of continuously raising round after round after round after round until the founders and early investors don't own any more of the company anymore. That's not really a good thing. A lot of founders unfortunately believe that their metric of success is whether I've lurched my way to my next round and got my next dollop of funding. But to me, that just looks you're staving off death for one more round. You really don't have a legitimate company yet because your customers aren't buying your products yet. So you're still kind of a quasi failure if you're just continuously raising venture round after venture round after venture round. So I vastly prefer companies get to break even as quickly as possible, such that if they want to raise money in order to accelerate growth, they have that option. They have the luxury of taking it or not taking it, but they're not forced to. They don't have a gun to their head. They're not going out of business if they don't make their next funding round, which is I've been there before, and it's not a fun thing.
Well, there's actually some ventures that I've heard over the years where not so much venture after venture the way you're describing it, but like they've won business plan competition after business plan competition after business. I mean, it's almost like that's their source of revenue, and I mean those are very time consuming. Winning 1 or 2 is great, but then like they have this whole string of them, and so after a while, that actually kind of counters the appeal of it. So
the SBIR program and the SBIR companies have that same trap. And those type of companies are called SBIR mills that simply do, or SBIR shops, SBIR mills. They keep doing SBIR after SBIR after SBIR and never graduate. They never actually put the product out on the shelf and get out and graduate and get out of the free money cycle. Instead, become used to these grants and figure they can win it and never give away equity and just do research project after research project. That's a similar sort of failure mode as the company that just gets venture round after venture round after venture round. These companies, SBIR mills, turn into 20 or 30-year-old companies that never grow beyond 100 people. and never really break out. And they're always working, by the hour on these hourly labor contracts. So that's another kind of failure. It's a pitfall. So there's failure on both sides. Becoming addicted to these grants or business plan competitions with these little tiny amounts of money, becoming addicted to SBIRs and never getting out of the cycle, and becoming addicted to venture capital and hiding from the marketplace in investor money. All three are failures.
So assuming like government funding is one factor that you look at in a pitch deck when you're looking to actively invest in companies, when you're screening companies, what kind of, as an investor, makes you pause to read more about a pitch deck? So outside the government funding aspect, what makes you more willing to meet a founder for kind of an introduction or approve them in like a screening process to make it into the next round? What are kind of the aspects of a pitch that stand out in your mind?
Well, let's divide it up into the pitch and the idea and the market and the product and all that, and then onto the founding team, which are two very important but separate things. On the idea itself, if I see something that has a significant IP moat, as the term you've probably heard, that solves a pretty significant problem that is, either it can't be done today at all, or is being done in such a horrible way today that this new piece of IP can dramatically and drastically change the market and change the business, that appeals to me. The market also has to be kind of large. Very often I see what I consider fairly exotic pieces of IP, but the amount of people who would buy this thing are just so small that it doesn't matter if they conquered 100% of the market's too small to be interesting. So unusual IP moat in a big market on the product side. Continuing on the product side, an easy to articulate value proposition to an easy to identify customer demographic, meaning that I know exactly the identity of the customer and the title, and they have budget ready, and they're buying similar stuff to what I'm making. And if I show up, I can articulate my value proposition so clearly and succinctly and lucidly that the buyer, yes, of course, absolutely, I can't not buy that product, of course.
It's interesting that given how deeply technical you are, and having that kind of deep tech interest of yours, I'm really glad that you mentioned this whole easy to articulate piece of it, because sometimes I think to especially very technically talented founders and folks, they seem to kind of either neglect that piece or may personally struggle with that. But with the technology being so intricate, why again, there's so many questions and we only have a limited amount of time, but why did you bring that up? Especially from somebody who, MIT pedigree and all that kind of stuff. Why do you want an easy to articulate value proposition?
Yeah, so you've hit, on a very, very sensitive and common problem amongst highly technical founders. They are so enamored with their own brilliance and with their own, inventiveness and how hard it was to come up with this new idea, that all they really want to do is to brag to other engineers who understand it, so they can pat themselves on the back and look like this, techno god, that they solve this technical problem. But the customers that actually buy the product, that pay the bills, they couldn't care less how the thing is made and why it does what it does. The only reason why they pay is because it solves a problem of theirs. Okay, that's an expensive, painful problem. Okay, so it's one of my jobs in mentoring CEOs and coaching, founders and sitting on boards is to, take the technical person and slap them around and say, hey, nobody cares, okay, how brilliant you are. Nobody cares how you made the thing, why it's so brilliant. All they care about is, what does this do for me? Okay, so shut up about how brilliant you are and how brilliant the invention is, and focus only on the person you're talking to, their pain points, and what this will do for them. Then they will buy from you. Otherwise, you're boring them to death, and they're just gonna mentally check out. They're not gonna engage with you. This is one of the hardest things I have to do with deep technical founders is convince them that the rest of the world just doesn't care. The rest of the world cares only about their own problems. Okay, so and I'm a technical founder. I was that guy 30 years ago. Okay,
so I think it's even more meaningful to hear it from you versus somebody who's not, deeply technical and says it, and then there's a little bit of like, well, you don't understand because you're not technical, but you do understand, so they can't say that to you.
I watch hundreds of mini-me's, run around all the time doing this, and I'm like, I look back and remember back to those meetings I had where I failed miserably, and that people were so turned off by my technical arrogance, or my fact that I just wasn't listening to what their problems were. I didn't seem to care about what their pain points were, and it's tough. But a founder who gets that message quickly and actually changes their behavior, in my opinion, is an excellent founder, because they get it. Like, okay, I understand. They don't care. They don't care at all why I did this, how I did this, why it works, blah, blah, blah. They only care what it does for them. Got it. And if they can make that mental leap and truly start internalizing it and behaving differently, that's a good founder.
I was going to say, it sounds like between these comments and the comments we had before, it might be a good segue into our last two questions. The first one being around what's the difference between a good business and a good investment. And we were kind of talking about that when you were talking about the venture capital mills versus the SBIR mills. But do you mind touching a little bit more on that, along that sort of structure? And then we can jump into the last question about prioritization between the founding team and the prioritization of the market opportunity.
So that's a pretty easy question to answer. A good business is one that, no matter its growth, is throwing off a large amount of profit, and usually the founders and the stockholders are paying themselves dividends. That's a great business. It may be a terrible investment, though, if one can never get their investment money out. Okay, if the measure of whether something is a good investment is, there's two main metrics. One, can I actually get my money out? Is there an exit somewhere in the horizon? And two, will that exit multiple, will the increase in value of my investment be high? That's kind of really it. Now, yes, there's a lot of equations in the second one, how to assess whether or not the exit can possibly be high. Okay, what are other companies like this selling for? What are the multiples on revenue or profit or growth rate and that kind of thing? And the first part is probability of exit at all. Is there a marketplace for companies like this? Usually people think of marketplaces as a place where products are sold, but there has to be a marketplace for the company too. So if a general purpose software company is appealing to Microsoft and Facebook and Google and Cisco and Salesforce, and there's a bidding war amongst all these big giants for this exotic new piece of software, that's a great market for the company. And you'll get very high multiples, and the multiples there are great. B2B SaaS multiples are wonderful these days. So that's a good investment. One where the probability of exit is high and the probability of high returns is high. That's really it. But there's tons of great businesses, as you said, that I'll take one look at. It's like great business, but nobody's going to buy this. The number of possible buyers of this company is, I can count on one hand, and they buy a company once every 10 years. So your probability of exit is horrible. Okay. And let's look at the exit multiples of the past X number of acquisitions in this space. Oh, they're all terrible. Okay. Oh, and let's look at the size of this market. It's actually a tiny market. So you're going to stall out at $10 million in revenue. You have a very, very profitable company. Maybe you'll pocket $2, $3, $4 million a year in profit off of this $10 million gross revenue company. But I didn't really buy into this company for long-term dividends. I bought it to get a big multiple on my investment value. So yes, there's a tremendous difference, but it is pretty obvious how to rate these things. Does the founder want to sell? Very often I'll get founders who are like, yeah, I love this business, I want to keep it forever. Why on earth would I ever invest in your business if you just told me in my face you want to keep it forever? You just told me I'm never getting my money out.
Right. So I've actually never experienced that one. I've experienced the other one where, they want to grow and they're they've got customers and they've got money, and so they're trying to raise funds, and then they're stumped when despite all that, and then the founder is great and personable and smart and coachable and all that kind of stuff, and they still don't get funded. I tend to get more of those. I haven't had the ones where they're like, oh, I want to run it for life. So.
Yeah, it's a lifestyle company.
Right.
Lifestyle, there's tons of friends who have lifestyle companies. It's fabulously profitable. They're putting cash in their pocket, but why they would ever ask for an investor, or why an investor would ever throw a penny into a company like that is beyond me. It's sometimes neither side thinks it through completely.
Right. So I think this segues us to our last question, which is, and you've touched upon everything so interconnected anyway. So, but you've mentioned about coachability of the founder and things of that sort when we were talking about the technical articulation of or the articulation of the technical value proposition in kind of regular non-technical speak. But in addition to that, what there's a little bit of a debate, two sides of the debate. If you had to pick one or the other, is it the team that tips the scale for you, or is it the size of the problem?
So a great problem, great value proposition, great technology with a weak team behind it will wind up going out of business. They just won't be able to reach the finish line. So I've been sucked into that trap a couple of times before, and I learned my lesson, and it's not an uncommon lesson. Amongst the TechStars MDs, the number one personality trait of a founder or founding team is tenacity. The product idea doesn't matter, market doesn't matter, but if a founder simply will not give up no matter what happens, they'll retrench, they'll fire 3/4 of the company, they'll completely pivot to a different business. It doesn't matter. Eventually, they'll be successful because they just, they're at bat so many times, and they know how, they have 9 lives like a cat, and they know how to, survive. the last day of my TechStars class, I put up a slide that has, the two rules of success in business. There's only two rules of successful business. Step one, survive. Step two, go back and look at step one. Okay. So if you simply survive long enough and keep getting enough, shots at bat, eventually you'll hit something. You'll hit something out of the park. If you die too quickly, obviously your chances are done. So as far as the number one trait on a team I look for, it's tenacity. Somebody who just can demonstrate somehow, some way that they've given up, just isn't in their DNA and not part of the vocabulary. They just won't. Okay. Another very important character trait is this sort of emotional maturity, where somebody can abandon their own ideas fairly quickly and not fall in love with their own ideas and ride them into the ground. So somebody who says, you know what, we were in market A sucks. I'm not gonna, we just have to admit it. We tried, blah, blah, blah. We discovered this other market B, we're shifting, we're dumping everything here, we're going over there. Somebody who can do that quickly, but somebody who says, look, I saw the signs, I read the tea leaves. It's not debatable anymore. This thing we were doing just isn't working, but we stumbled across this other thing that does appear to be a lot better. We're moving. We're going from here. So a founder that can has emotional maturity to pivot quickly and do the next thing or do something differently because the first thing isn't working. That's again one of the top, certainly one of the top 5, perhaps number 2 personality traits. And then if you keep going, somebody who doesn't have a big enough ego that prevents them from hiring people that are better than they are. This is a maturity thing. Somebody who's a little too arrogant or has a weak ego. They say that B people hire C people, but A people hire A or A plus people. So somebody who's like, I need the best person on planet Earth. I'm presuming that they're going to be smarter than me. They better be smarter than me. That's again in the top 5 quality traits of a good founder. So I'll stop with those 3. So I think if you get a founder with those 3 traits, or a team or a bunch of people team with those 3 traits, it's a pretty winning team.
The question was, how do you evaluate that management team? Do you look at kind of prior experience? Is it just a feeling based on meeting them when they're pitching, or how do you go about evaluating the team?
It's both prior experience as well as the questions you ask in the interview, which is one of the reasons I do like to mentor companies for a little while before deciding whether to invest in them or not, because I can see how do they respond to my questions. If I give them some advice and come back a week later, do they forget it, or do they take it, or do they modify it? There are things in somebody's background that you can examine that would give you an indication. Did they have 2 or 3 companies successful before? Obviously, a serial entrepreneur that has 2 or 3 successful companies before, that's a very, very good bet, because they know how to do it and they've seen it before, they've done it before, they have the emotional maturity. Even if a founder's only had 1 or 2 successes and 1 or 2 failures in the past, that's still very good, because they've, a founder that has had too many successes in a row actually may have some blind spots that make them, not aware of the train coming the next time. So I kind of like a founder that's had 1 or 2 successes, 1 or 2 failures, because they've got a taste of the bad side too, and they've learned something from it.
Warren, do you prefer to invest in serial founders, or will you give first-time founders a chance, especially if you don't know them, if you see it as like through an application or a screening process, and maybe that doesn't really happen to you anymore because you've been investing for a long time and you've slowed down and you only take referrals. But what does a first-time founder have to do to catch your attention in the screening part of it? Maybe take an introductory meeting before the actual kind of pitch meeting. Like, what makes you even go through and say, oh, maybe I will invite them to pitch?
So my last 2 investments were both first-time founders. My very, very last 2 investments were first-time founders. Almost all of my TechStars portfolio were all first-time founders. Any companies that go into an accelerator are usually first-time founders. Why? Because they need the help, because they don't have the experience. A multi-time founder who's founds a company is going to immediately have all the names and phone numbers of all the venture capitalists who made money off of their last company, and will be able to raise money instantly at very high valuations. The valuation disparity can be very huge between a first-time founder and a multi-time founder. So I do tend to I don't exclusively look at first-time founders, but I will invest in first-time founders because the valuation of the company is usually quite a bit lower than a serial multi-time founder where their first round has a pile of professional VCs in it already at an A round level. So I do look at both, which makes it much more difficult to assess the personality traits of the founder because it is their first time. They don't have a track record. It does take a while to get to know them and to learn about them. Where you don't have to do that with a multi-time founder, but there's a pricing differential. So
great. No, that's a great point. Thanks for bringing that up. So thank you, Warren, for being our guest investor, and that wraps up this episode of Inside the Mind of an Investor. Thank you.
My pleasure, guys.
Thank you.